Good morning, everybody. Hey, it is Friday, the 5th of April. Welcome to the last full week of, the first full week of this month and this quarter. So we're getting off to, let's just say, a shaky start for this quarter. We had a really not good day yesterday. Matter of fact, I think they said it was the worst day we've had in over a year when it comes to the indexes. Everything was in solid red territory, anywhere from the Russell 2000 down 1.08% to the NASDAQ being down 1.4. So we'll talk about those things and more when Dave joins us here in just a few seconds. But hey, it's days like yesterday that make us want to make sure that the amount of risk we have in our portfolio truly matches up with the amount of risk we should have in our portfolio. That's why I developed the core retirement design to help folks design that retirement they always dreamed of, to be able to enjoy it, knowing how much risk they have and knowing how much risk they should have in their portfolio. That's the core retirement design. Give me a call at 863-382-0037 to schedule your core retirement analysis. And with that, we've got the Statler Financial Radio Show coming up this weekend, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk 730, 95.3 FM. Join us then. All right, Dave's coming up next.
Light FM. Thursdays there. Morning Dave is here. It's 8:42, 18 before 9. Let's check in and find out whether or not Wall Street found its shoes. I mean, kind of lost its shoes yesterday and fell like a rock. Let's find out what caused it with Phillip Statler from Statler Financial Services in downtown Sebring. Phillip, nobody jumped out of the window at your place yesterday, did they?
They did not, but I don't know about losing shoes, but they sure lost their shorts yesterday.
Yeah, we definitely took a bite out of our hinders yesterday afternoon. What happened was the Federal Reserve Governor of the Minneapolis Fed. He did the rubber chicken circuit at noon, and he said that he would question the need for rate cuts at all if inflation doesn't go down from where it is right now. And that kind of the song you and I have been singing for quite some time, but it's a solo act as far as Fed governors are concerned. And the Dow went down by 530 points. The S&P went down by 64 and a quarter. And the NASDAQ went down by 228 points yesterday. All three of the major indexes were down by over 1%, and the NASDAQ was down almost 1.5%. I didn't check the Russell. I'm going to assume that was an even bigger bloodbath.
Actually, it wasn't quite as bad as the others. It was down, but I think if I remember, I was down 1.08%. So it may have been one of the better ones of the four.
It had some it had some larger downward swings earlier in the week, so that might have done it. My initial reaction when you picked up the phone before we went on the air was, gosh, that happens when a guy that doesn't even have a vote on the open market committee right now says it. Can you imagine how bad it would have been if he actually had a vote?
Yeah, that would have definitely, it could have been. I mean, yesterday was the worst day we've had in over a year anyway, but you add that would make it even worse.
Yeah, it was the biggest drop we've had since the banking crisis last year, and we were all scared that we were all going to die because the regional banks were having problems. And yeah, we had a couple of 500-point dips then because we were scared to death of the banking industry. But this time it wasn't an industry thing. It was just, oh, good Lord, they're changing their minds. And like I said, this guy, they rotate the Fed presidents on the open market committee. It just isn't Kashgari's turn. So he doesn't even have a vote, but good Lord. Now, the rub on this is going to be we've got a Federal Reserve president with a vote. Michelle Bowman is going to be speaking the rubber chicken circuit at 12:15 this afternoon. Gosh, I hope she doesn't say the same thing he said.
That will. If she did, I think it would be a back-to-back bloodbath days.
Like I said, she can actually make a decision that could do it. It was just, Now we add on the federal data dump this morning. The unemployment rate came out and the jobs added. I was surprised when you told me the reaction was somewhat muted when it came out. The unemployment rate is exactly what they expected, 3.8% of the federal unemployment rate. But non-farm payrolls added during the month of March, they were expecting around 200,000. We added 303,000 new jobs to the economy last month, which kind of gets into that good news, bad news setting, because after hearing somebody say that things are not going to look good for interest rates if the economy stays so hot, so what happens? We overachieve our estimated job gains by 50%. That's interesting.
Not good. Yeah, it's not good. But I will tell you that you're right. When we first got that news at 8:30, we saw the indexes, the futures, basically cut in half or a little bit more. But they bounced back off of that, and actually they're trading higher now than what they were before the announcement was made. Now, that's no guarantee that that's where we'll open at, but definitely they're bouncing all over the place, Dave. They bounce up, then they bounce lower, and so there's no steady stream of saying, okay, this is the direction that the indexes are going, because they tend to trend higher and then they trend lower. So not sure how this is going to affect the open at 9:30 this morning.
It sounds to me like there was a whole lot of decisions made ahead of time that if it achieves it on the jobs, I'm going to make the following shifts in my investments, and I'm going to do it on the futures even before the market absolutely opens. And now we're seeing basically shifts in allocation. Sell this, buy that, readjust based upon expectations, whatever your expectation happens to be. It's going up and down. That's kind of the way I read it. Isn't it yours?
Yeah, it is, and I will tell you that has affected interest rate yields on the treasuries. They have ticked up since that announcement was made, and so now we got the 30-year over 4.5%, which it hadn't really been there for a little while. So it's definitely putting some pressure on treasury yields right now.
Doesn't bode well for mortgage rates and housing information, and we get it through the month ahead as well. I do not have the labor cost factor that also comes out of the employment report, but I did find a report earlier today. If you want to get a raise, well, change jobs, because the median year-over-year pay increase for job switchers in March was 10%. Staying put, you aren't getting raises to speak of, but if you change jobs, there's a 10% increase in pay, which translates into labor costs. So if you raid the guy across the street, you're increasing the labor cost figure for business by about 10%. That kind of surprised me, that big a difference.
Yeah, it is. But that's showing you what the shortage looks like right now in the labor market to find good folks.
Absolutely. The other thing that was putting a cap on things yesterday just accelerated the interest rate scare. After we get to the futures, you'll see it as the price of oil. And I was reading one report that says that Saudi Arabia and the Arab countries are trying to make sure that President Biden doesn't get reelected, so they're clamping down on the oil supply, and that's got us up into the $86, $87 a barrel range, and we all know what that does to the gas pumps, and that isn't helping the attitude of investors one tiny little bit. The fear and greed index that I quote a lot when you're not here, it's now moved from extreme greed a week ago down to greed for most of this week. It's now all the way down to neutral. It very rarely makes that big a change inside of a week, but the combination of Fed speak and the rise in interest rates, it's getting investors' moods a little touchy, isn't it?
It really is, Dave. And we've been looking and reading and talking, and the issue is nobody knows what's going to happen this year, but inflation is still not really under control. We continue to see that those numbers come out, and I think that you and I talked about how long it takes for interest rates to get baked in and how long it takes for them to start affecting our economy. And it's taking longer than we expected. And I think that's only because of the jobs market. But ultimately, those interest rates are going to affect earnings and are going to affect you and I, the consumer. And I think that maybe we may be seeing that in that fear and greed index and in the consumer confidence numbers, that our confidence is starting to wane a little bit because of all that pressure.
Right. You and I have been talking about that delay, that lag between implementation of an interest rate increase and its effect on the economy. Yeah, most of the rate increases that we had last year are now being felt and are now having an impact. But there's a residual effect on that. Corporate bonds roll over and renew, and then the increased yield starts showing up, and then the corporate interest rates start going up. Ditto on the federal budget as federal bonds renew. I mean, this is a continuing ratcheting up of expenses of doing business and doing government as things renew and the higher interest rates kick in and the interest expenses start going up. We're going to feel that, and that's one of the reasons why that article we were reading the other day about that the multiples on the Standard & Poor's 500 are starting to approach bubble numbers, even though the actual index is just hanging around its high.
Well, that's true. We continue to have some concerns about what that's going to look like, and can we, are we still gonna have a soft landing, Dave? That really could become somewhat questionable as we look at moving forward. I hope that we can get through this still with a soft landing and be able to get this inflation under control quickly so that we can get through this. It just seems to be that we linger and linger and linger when everybody thought that by end of last year, first quarter this year, we would be through this process and on the other side. And it just keeps lingering, and we just can't get through it.
And a big chunk of that too. It puts a real onus on the Fed, and it's one of the reasons because this economy is so darn big, and we've got the residual impacts to things that we do in October of 2023, still feeling the impacts, and we will still be feeling those impacts in the middle of 2024 and beyond. It's why generally our Federal Reserve does not have a good track record or reputation among the world banks for making the right adjustments at the right time. It's not necessarily their fault. The fact their economy is so doggone big, it's like turning an aircraft carrier around, and you just can't do that real easily.
No, you can't. I found this headline interesting here. Economists, I talk about Arian quite a bit. I've followed him for a long time, but he came out with a statement this yesterday, I guess. It says the Fed has turned into a play-by-play commentator.
Not a bad term. It really and truly isn't. So anyway, we're sitting this morning kind of wondering just how touchy we're going to be. And like we both said, I think that Fed speak, rubber chicken speech at noon might have more impact than it otherwise would. Tidbits floating around talking about employment this morning. Apple, of all companies, announces they're going to lay off 600 employees in the context of the company. That's not all that big, but the layoff number, the layoff fact itself is.
Well, it is, and it's kind of unusual to see that coming from Apple, but I did see that it's because they're shut down their automotive division, basically, and so they didn't have any place to put those folks, and so that's, I think, what caused that layoff, and so they are reassessing, what technology areas they really want to be in, and that was one of them they wanted to get out of, and so they had to get rid of some employees to close down that division.
Mm-hmm. When they made the announcement, they kind of covered their butts by saying they were going to transfer most of them into their artificial intelligence division, but evidently they couldn't find enough real intelligence to go to artificial intelligence and had to lay some off. We would be remiss because our 500-pound gorilla up the road dodged a bullet. Disney managed to beat their hostile investor coup the other day, and the board of Disney stays as is. I don't know whether it's good news or bad news, but the guy that wanted to basically break them up and sell the parts did not win the election with the stockholders. We probably need to mention that just because they're so big around here.
Well, yeah, and that's, Disney has made some changes, though, and they have divested themselves of certain areas that haven't been real winners for them. But to break up a whole company like that, I'm kind of like, it's a whole sphere, right? If you take one part out, then it messes up with everything else.
Absolutely. It needs to be mentioned right now. They're going to continue on that slow but steady course that Iger evidently wants to do. Resetting the table. Yesterday, I got no better term for it. Basic bloodbath. All the major indexes were down by more than a full percent. 45 minutes before we opened this morning, what are we looking at?
So we've got some green ink this morning, but we had green ink yesterday morning too, right? So
Yeah.
that's not necessarily a promise of where we'll end up the day or the week. So the Dow's up about 1/3%. The S&P 500 is up 0.4, and the Nasdaq 100 is up about 0.5%. The Russell is down about 0.4 this morning. On the other side of the coin, we've seen silver digress down 1.9% below 27 at $26.72 an ounce right now. Gold is barely keeping its head above $2,300, down a little over 1/10% to $2,305 an ounce. And crude oil, man, it's trying to get to 90, Dave. It's up 1/3% to $86.88 a barrel.
And that ain't helping anybody's attitude on the market, that's for sure. Overseas markets, the Asian Rim finally looked at us and said, these guys really don't have their act together. Everything was pretty much in the negative territory. Japan was down almost 2 full percents at the close this morning. Most of the rest of the Asian Rim market down about 0.5%. Europe is not doing well this morning. They're selling off based upon our activities from yesterday. Overall, European indexes are down about 1.1% halfway through their trading day, which is certainly not good for a trading partner for us. Got to get my retirement plan stabilized, especially if I got too much equities. Look at the last couple of days. Your net worth just went down by quite a bit. How do I find you to insulate me from all those?
Dave, that's why I developed the core retirement design, to make sure that the folks out there have enough risk in their portfolio, but not too much risk in their portfolio. Give us a call at 863-382-0037 to schedule your core retirement analysis. And then join us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday mornings on Highlands News Talk 730, 95.3 FM.
And again next week, about the same time each day here on Light FM. Phillip, I'll catch you next week, all right?
All right, buddy. Have a great day.
Thank you, my friend. It's 105.7 Light FM and Statler Financial Services. Phillip Statler.
Do you actually read your financial statements? Or
Folks, again, I want to thank you for joining us today. Have a great weekend and join us again next week right here. Take care. Bye now.